Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today, we'll talk with my number one macro guy, Marko Papic. We'll check in with him about Ukraine and other topics. In the mailbag today, questions about bank deposits, tech stocks, and more. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, did you notice the flash crash on Tuesday? I'll talk about that and more right now on the Stansberry Investor Hour. What flash crash am I talking about? Well, I'm talking about the print in the SPY, the Spider S&P 500 ETF. It is the biggest ETF in the world. It has, according to data compiled by Bloomberg, a market cap of just over 400 billion, right? Biggest ETF in the world. I mean, and the S&P 500, biggest equity index in the world. There's well over $1 trillion. Actually, they were saying $1 trillion a couple of years ago. It's probably trillions now attached to the S&P 500 index. So Tuesday, January the 25th, at around 2:08 p.m. Eastern time, I don't have the exact moment. It was right around there. I'm confident within about 3 or 4 minutes. It looks like the SPY, the Spider S&P 500 ETF, went from like 440 instantly to 370 and back up. That's 16%. That's a hell of a move instantly. One slight problem with this, I can't verify that the trade happened. One source indicated that maybe the trade was canceled. So maybe this was what they call a spoof, right? Because the volume spiked as well at that time. And I'll tell you what I'm going to do. I'm going to go ahead and assume it happened because I know that it can happen. And if you can spoof and pull back the trade and not do it and pull the quote down that fast and then back up, you can trade it, right? So I'm going to assume it did happen. And wow. So I've talked about sort of this. We're getting in the direction of what I've talked about, haven't I? My last two times, this year and the year before, my top surprises for the year, my top 10 surprises included the possibility of the S&P 500 falling 20% or more in a single day. And of course, the or more is controversial because there's a circuit breaker mechanism whereby if the S&P 500 falls 20% in a single day, the exchange shuts down. So, how can it fall more than that? And my belief is that markets are not machines created by human beings. They're things that happen when human beings get together. And all the machinery is just sort of, it's a sign of the times. It's, if we had markets, and we did have them, we've had them for eons. But 200 years ago, we didn't do it with computers. But it's the same thing. It's the same human natural phenomenon. So humans don't control them. Humans are in them, the way fish are in water. So it's a little rich and a little arrogant to me to suggest that you can say the S&P 500 will never lose more than 20% in a single day because we've got circuit breakers. I don't know that it really works that way. But this thing appears to have happened on Tuesday, showing that, yes, the biggest ETF in the world that covers the biggest index in the world can indeed fall pretty darn close to 20% in an instant. And I just wanted to point it out to you. even if we find out ultimately that the trade was canceled, I still think that this validates. It's in the direction of validating my thesis, and it's something that you need to know can happen, right? I believe markets are riskier than they appear. More things can happen than will happen, surely. But you don't get to know in advance which ones are going to happen. Okay, so there is just massive uncertainty in markets, more than is acknowledged. And in an event like, let's say this is it. Let's say the bear market has begun and the top is in. And, even if the top isn't in, this could be it. This could be the beginning of the end of the great bull run that started in March of 2009. If that is true, then this little blip, whatever it was that occurred on Tuesday, this little mini flash crash, I'm calling it, we could see more of that. It's my belief that we're hardly into this. If this is a bear market and if this is the end of this, we haven't scratched the surface, right? I mean, this is the proverbial tip of the iceberg. It is not. It is not the big one, right? So anyway, I just wanted to point out that can happen. Maybe it did happen on Tuesday. It looks like it did happen. Another thing I wanted to point out real quick before we talk with Marko Papic is that big money has been flowing into the big gold and silver ETFs, the GLD and SLV, the big ones that hold gold and silver. And, I think it's like 149,000 ounces was the last thing I saw just in the past week into the gold ETF, and maybe 2.3 or 4 million silver ounces into the big silver ETF. That's interesting to me. I think that we're at least seeing signs that institutions are kind of changing their tune, right? Sell off in the NASDAQ, big flows into gold and silver. This may wind up being a harbinger, of things to come. And I just wanted to point it out to you. I still think my basic, what I call truly diversified portfolio holds, right? Good stocks, sell your garbage. If you don't know by now that your speculative garbage is pretty much done, you're not paying attention. Sell your speculative garbage and by all means, hold on to your good long-term, wonderful business stocks, but have plenty of cash and have gold and silver and maybe some Bitcoin. That's the last thing I want to point out before we move on to Marko, is that just a couple of days, like, Monday and Tuesday, we started to see a move in Bitcoin. Bitcoin started to look like it was kind of bouncing off a bottom, I think maybe around $32,000. And that was interesting because at the time, the equity indexes were still falling. So maybe, remember, we had Mike McGlone from Bloomberg on the show a couple weeks ago, and he said that he thought this was the year that Bitcoin would decouple and stop behaving like just another tech play, just another volatile risk-on tech play, right? And I don't know, maybe that's what that was about. Maybe there's money going out of equities and into Bitcoin, and it started happening Monday and Tuesday. We'll see. I personally have blew out my Ethereum. I had some Ethereum. I blew that out. And what do I have? A tiny amount of Solana that I don't care if it goes to zero. It's so tiny. But I've been thinking about adding to my Bitcoin. Haven't done it yet, but who knows? Who knows? I certainly am not selling my Bitcoin, for whatever that's worth to you. And I'm not going to tell my extreme value readers to sell it, that I know of. We can change our minds, but I don't see any problems right now. So with all of that, with the flash crash and the flows into gold and silver, and maybe Bitcoin is decoupling as a risk on tech play. That's all I have to say about that for this week. And let's talk with Marko Papic. Let's do it right now. And now an important update. A major shock is about to hit the U.S. financial system. It has nothing to do with inflation or the resurgence of COVID sweeping the nation, although they're both definitely making this situation worse. Months of stock gains could go up in smoke because nobody's done a darn thing about the zombie problem lurking behind all the flashy gains last year. Now, if you understand what's coming, it's about to hand you a wave of opportunities unlike anything else anywhere, each one of which could double your money or more, plus send you a dividend-like payment of 10 to 20% or more while you wait for your legally protected payout. These opportunities will come fast, and it's critical that you know what to do now well in advance. For more details, visit www.messagefromdan.com. Again, that's messagefromdan.com. Time for our interview. Today's guest is Marko Papic. Marko is a partner and chief strategist at Clock Tower Group. He leads the firm's strategy team, providing bespoke research to clients and partners on geopolitics, macroeconomics, and markets. Prior to joining the firm, Marko founded BCA Research's Geopolitical Strategy practice. In 2012, the financial industry's first dedicated political analysis investment strategy. Marko began his career as a senior analyst at Stratfor, a global intelligence agency, where he contributed to the firm's global geopolitical strategy, as well as its analyst recruitment and training program. In his academic work, he helped create the Center for European Union Studies at the University of Texas at Austin. Marko holds an MA in Political Science from the University of Texas, Austin, MA from the University of British Columbia. And with that, Marko, welcome back to the show.
It's such a pleasure, Dan. Thank you so much for having me.
You bet. So I have to say, Marko, at this point, you're like my main go-to macro guy. And my wife watches all this news on TV and she gets worried about things. And I used to think to myself, well, I'll make a note to talk to Marko about that. Now I just tell her, hold on, don't worry, I'll talk to Marko. So that's a lot
of pressure.
Yeah, I know. Don't worry. I'll face the full brunt. But the issue now, of course, that's on everyone's mind, is certainly on every news program, is, of course, the Ukraine. And a friend of mine who actually works for Stansberry Research has lived there for over a decade. And I shot him an email this morning and said, hey, how you doing, man? And he said, we're fine. Everything is fine. People are going about their business. He says, I live near the main street of this whole country's finance industry with like 20 bank offices within a few miles. Everybody's going to work. Nobody's worried about anything. The store shelves are full and nobody's panicking or anything. And yet, to watch Western mainstream media, you wouldn't come up with that conclusion. You certainly would not. So between those two, where do you fall on this issue?
I think I'm definitely with your friend in Ukraine, actually. Oh. Yeah, no, I mean, first of all, we've seen Russia be aggressive before, and usually it's preceded with quite a considerable amount of propaganda on domestic television and news. So, for example, before the annexation in 2014, Russian TV was basically telling its citizens that, neo-Nazi hordes were on their way to Crimea to ethnically cleanse Russian speakers. That hasn't happened this time around. And I think that Vladimir Putin is very, very sensitive to domestic sensibilities. And there doesn't seem to me, and this is a very qualitative statement, so obviously, I got to hedge a little.
Sure.
I could be completely wrong, but it doesn't seem to be this propaganda machine in Russia to prepare the country for a long and really difficult Afghanistan 2.0, or 3.0 if we count the American Afghanistan experience as the second, Soviet first. So this would be Afghanistan 3.0 for Russia if it invaded Ukraine. And there's no real prep for the domestic audience on that front.
Okay, so my friend in Ukraine also says, there is actually some worry, I don't know how much, he didn't say, of a coup in the Ukraine, which would result in, kind of inviting Russia in, maybe. Well, how does that sound to you?
I don't think that that's possible. Not that the coup is not possible. Not that the coup is not possible, but I think a pro-Russian government in Ukraine is never going to happen. And let me explain why. Imagine if you took Texas and Florida out of the United States of America. You would never again have a Republican president. And the mistake that Vladimir Putin made in 2014 is that he took, Ukraine's Florida and Texas out of Ukraine. Crimea, which consistently voted for pro-Russian politicians, and large parts of Donbass no longer vote. And so Ukrainians are all aligned that they don't want to live in the Russian sphere of influence. But some sort of a political change could happen where the leadership in Ukraine says, okay, cool, we don't want to be in the Russian economic sphere of influence, but we'll take the Finland deal that Finland got in 1945. And the Finland deal, after the Great Winter War of 1939, what Finland got is it gave up about 10, 15% of its territory and its second largest city, just gave it to the Soviet Union, promised it would remain neutral, would not join Western international organizations like NATO or some sort of an economic European community. And in exchange for that, neutrality, it would be allowed to have a domestic kind of Western democratic and capitalist system. And that's, I think, all that really Putin wants. I mean, these guarantees of NATO accession are vacuous because Putin knows what everybody else knows. Germany and France would never accept Ukraine into the NATO.
Yeah, if that actually is part of the official narrative that is repeated ad infinitum these days. So final question, of course, is do you care at all in terms of capital allocation here?
That's a great question. No, of course, and that's something that we're thinking about a lot. I mean, look, if I'm completely wrong, Putin rolls tanks into Kiev and we have a massive war on Europe's borders, I do think that there would be macro implications for investors sitting in the US or everywhere else. Right now, I think this is a local regional issue. Why? Because the number one driver of markets right now, as they're melting down, is optimism. It's actually optimism. And I know that a lot of people don't want to hear that, but actually what's driving markets are two things. One, COVID is over. Omicron is basically the common cold. To be frank with you, Dan, we knew that 2 weeks after it emerged in South Africa. I had all the data I needed to make that call. But obviously the media re-emphasized its danger for the next 2 months, and still is, by the way. But the markets are done. The markets are done. They're like, okay, cool, COVID's done. The second issue is China. China's panicking. It's pulling the stimulus lever. And COVID in China conspired in Q2 of last year. COVID in China conspired to basically create a tailwind to safe haven assets. What are safe haven assets? Two things, bonds and US FANGs. Everybody and their aunt plowed into American markets and overvalued tech plays because China was basically deleveraging in 2021 and COVID was a big deal. Those two macro drivers are now reversing. Bond yields are shooting up, and obviously tech stocks are getting crushed. And so I don't think that Ukraine can really change that unless, and this is ironic, and I'm just going to throw it out here, this is a completely crazy view, but unless Putin does invade Kiev, it rallies the bond yield, and then FANGs catch a bid again. That would be ironic, wouldn't it? That actually invasion of Kiev stops this sell-off. But inflation, Chinese reflation, COVID dissipating, and Fed being hawkish, I think that's driving this market. I don't want to catch a falling knife with US tech stocks. What I want to start doing is diversifying into emerging markets, into commodity-producing economies like Chile, like Brazil, that are actually weathering this downturn quite well. And that tells the market doesn't care about Russia or World War III, because if it did, EMs would not be outperforming U.S. stocks.
What do you think about Japan right now? That was the one that I that caught my eye recently, mostly because of, I read the stuff on GMO's website, and they highlighted Japan recently. They said the traditional perception of it is not valid anymore. People used to think of it as this low return, nightmare for all eternity just because of the way they run their businesses. What do you think of Japan right now?
I mean, I think that this year, 2022, will be a year driven by non-U.S. stocks. If I'm right that Omicron is in the back, China's reflating, Japan is pretty high beta to China. And if China's panicking and stimulating, which we think they will be doing, haltingly, by the way, it won't be obvious, it'll be halting. I think Japan should do well. I think Europe also high beta to China. And as I said, commodity producers to me would probably be more interesting. So like Latin America in particular, Russia too, once this is in the bag, Russia will have huge geopolitical alpha opportunity, provided I'm right that it doesn't invade Kiev. But I think commodity producers are interesting, Dan, because commodities ignored dollar strength, ignored total social financing collapse in China, just ignored it, just plowed ahead. But EM equities of commodity producers and EM currencies of commodity producers did not follow that party, and I think there's considerable catch-up potential this year.
Okay. I was going to ask, so that sort of gets us into another topic that's on a lot of people's minds, which of course is inflation. And there's still, a fairly strong camp that is saying, well, this is more transitory and it's not, 1973 all over again or something. How do you feel about that?
Care? I mean, they will never be convinced. That camp will just stay that camp. I mean, I think, it's definitely difficult for me to see because that camp. What's the point of that argument? The point is that look, eventually we'll be below 2% and everything will be fine, and you'll be able to invest the way you've invested over the past 12 years in this kind of disinflationary cycle. I think that's not true, to be polite. And I think that.
Well, it's certainly foolish to count on it, right? It's foolish to commit to that at this point, right? Even if I don't even feel like you need a long-term view. It's just, do you want to bet that way right now? No, I don't really think that's a good idea.
I think a lot of folks, maybe then think, well, Marko, if you said that you're no longer in the COVID is important camp, if you're basically in the COVIDiot camp where, it doesn't matter anymore, which I am, should you not then also have a view that inflation will peak? Because clearly COVID brought inflationary pressures. In my view, that would be like, well, nothing is a 1 or 0. Nothing is black and white. There's a lot of grays in between. And obviously, I agree that COVID and the stimulus packages had a lot to do with inflation. But what we're seeing is also geopolitical issues that are not transitory. U.S.-China confrontation, this new national security prerogative to build redundancy into our production lines, that's inflationary. So is the green energy transition, which I believe in. I think it's going to continue. Unassailed, but it's going to increase energy prices. These are all quite inflationary, big picture issues that the Fed can't deal with by raising interest rates. Right. And so I do think that, again, I think inflation will continue to be an issue. The question for me is, what does the Fed want? I highly doubt they want to return to 2 to 3% inflation. I think, honestly, some point this year, they'll take just peaking as a win. They'll find a new term to give it to us, transitory.
Sure.
But this time it'll be like, we're asymptotically approaching our mandate. And like, oh, what does that mean?
Yeah.
That means they're cool with 5% CPI.
Yeah. Right. The goalpost will be moved until the game is won.
Well, unless they want recession. That's, unless they're willing to incur a recession to arrest, elevated CPI.
I'm glad you brought that up because, Jamie Dimon on JP Morgan's latest conference call, he harkened back to the era of Paul Volcker. And he said, this is nothing, we went up 200 basis points on the Fed funds in a weekend or overnight or whatever. And he said, I think they're going to raise rates 6-7 times this year. I thought, first of all, it's not 1979. I mean, it's just not. Right?
That's the answer to that.
I mean, it's not 40% or whatever, 35% debt to GDP. It's a different world here, right? I mean, no?
Well, absolutely. Also, I don't think there's a political buy-in. So one bone I have to pick. One thing that I disagree with right now, there's this narrative out there that inflation is a political problem. It's like hashtag inflation sucks. Yeah, it is. Don't get me wrong. Biden's like out there swearing at reporters when he gets asked, blah, blah, blah. But when you say it's not 1979, what I take from that comment, aside from your point about debt and different world, I also take a point that in 1979, the United States of America had experienced 8 years of inflationary, malaise. Today, we got like, what, 6 months of CPI elevated, and everyone's about to light themselves on fire. And what I mean by this is I highly doubt that the median voter in America truly is ready to face a recession in order to deal with the current inflation.
Right. And
Paul Volcker would have been, he would have been hanged had he been in power, by the way, at the Fed, and had he tried that in 1971 or 72. In other words, the US median voter was not ready for pain. Voters, and you might counter and say, well, Marco, voters are never ready for pain. I disagree with that. I think when voters put a lot of austerity politicians into power in 2010 in the UK, in the US, when the Tea Party rose, people were ready for tightening their belts and realizing that the government had to kind of tighten the belts. We are nowhere near that right now. I think we will be at some point. And then I will take the bet of recession over inflation.
Right. So I just Googled because I couldn't remember it. My memory would not serve me back to 1974. But that was the year that they did the whip inflation now grassroots movement. So 1974, right? So I don't know, what was the S&P 500 1973 to 74, like minus 50 or 60% or something crazy? So yeah, maybe that's what it takes, huh?
Look, I think we are in a political world that is much different from the 70s. I think there's so much polarization. Income inequality is much greater than it was in the 70s. And I think that they're going to basically, inflation is a headline risk. It's something that's in front of their noses. The moment that yield curve starts inverting or threatening to invert, the moment recession rises its probability, they'll back off. They don't have the stomach for what I think is necessary. And by stomach, I specifically mean like the median voter is not ready yet for real pain. They're ready for sort of like, oh, inflation sucks, please do something with it. But let's see what people are talking about when S&P 500 is down another 10, 15%. Let's see what happens when there are cracks in the system and unemployment starts itching higher, or businesses cannot deal with higher rates, things like that. I think at that point you'll see them back off, which is something that Volcker would not have done. He knew what he was doing. He was like, hey, you want inflation to stop, we need unemployment to go up, we need a recession.
Right. Okay. I'm with you. I'm with you on this issue. So I had to cover Ukraine. I had to cover inflation. You mentioned China. Do you have a like a number one sort of capital allocation idea right now? Is there something that you're more excited about to do right now than you were, I don't know, a few months ago or several months ago?
Yeah, I think the sell-off, which I've been expecting since early December, the Santa rally ripped my face off, as it's known to do to bears. And so I actually really only turned bearish for the first meaningful time since COVID started, in December. And what I've been very encouraged by is the performance of EM assets. As I said, you can sniff out, outperformance relative to dollar, relative to U.S. equities of some of those emerging markets. So I would say that, and this is, by the way, not a popular view. When you talk to institutional investors,
EM is, that's right.
Billions, EM is terrible.
That's an understatement. I mean, EM is like, forget it. Yeah.
Forget it. And the number one thing I keep getting from allocators in the institutional space is Marko politics. And I'm like, look, I mean, politics were terrible when you were plowing hundreds of billions of dollars into EM in the last decade, which didn't work out. It's not worse than it was back then. And you already see, like, the Chilean president, who's a leftist, just appointed a bunch of moderates to his cabinet. But it doesn't even matter. Look, commodity producers are cheap. Their currencies are cheap. Their balance of payments are in surplus. Their current accounts are in surplus. They went through their balance of payments. And last year, you know what they were doing? They were jacking up rates, other than Turkey. They were jacking up rates. They were doing exactly what we taught them to do through IMF and World Bank programs, while America was basically printing like the most populist regimes in the world. So emerging markets took the pain last year. They took the hit of tight monetary policy. They're cheap. Their current accounts in their surplus. And commodities have risen massively. Karl Marx could rise from the grave and run Brazil, and I'd still buy it. Like, I just don't care who's in charge. The macro setup is really neat at this point. And I think that, I think we're going to end the year 2022 and we're going to be surprised. Again, a lot of that hinges on whether China does truly stimulate. China's got a lot of problems, a lot of problems. They're panicking. I think they're going to continue to be stimulating. The policymakers there really want to shift away from their austerity of last year. So a lot of it does hinge on that forecast being correct. So far, so good, though.
Right. So just for our listeners' sake, would you say that, it would not be unreasonable, let's just say, to put on a little bit of, just something like a Chile ETF or a Brazil ETF? I mean, they're loaded with the big commodity producers anyway, aren't they?
Yeah. And, it doesn't even matter if they're not. So it's interesting because Chilean
Right. You get the
equity
currency.
market actually, it doesn't have any copper exposure, but it doesn't matter. Like, it's not like banks in Chile are going to, do poorly if there's like manna from heaven dropping. Copper is at all-time highs. And this is the thing, Dan, last year, copper and all these metals should have gotten killed, and they didn't.
Yeah.
The market is telling you we're in a commodity super cycle because of inflation, because of the green agenda, because of all these, because of underinvestment, right? It's screaming at us that we're in a commodity super cycle. And I think a lot of investors have not done the second, third derivative of that trade, which is, of course, then, moving into emerging markets.
All right. So, but short term here, Marco, you and I know how this kind of thing works out. I mean, last year, commodities screamed. I think the Bloomberg commodity, S&P, what is the one that I look at on Bloomberg? S&P GSCI, the former Goldman Sachs commodity index.
Yeah.
It was like 40% or something last year. So that's a pretty ripping hot year, and it would make sense for that to correct. That'd be a pretty normal time for that thing to correct a little bit, right? And right now we're in a drawdown. We're double digits down on the S&P 500 as you and I speak.
Yeah, and WTI is up today. Brent is today. Okay, that's today. It doesn't matter, right? One day move. But I don't know. Look, Dan, here's the thing. Omicron hits, oil's down 7% in a day. I remember this because I had a bet the day before with a good friend of mine saying oil was going to look through dollar strength. Boom, Omicron news comes out. Oil's down 6% in a day. I look like an idiot. And yet we're at $80 oil, right? After that December blip, November, December blip.
Mm-hmm.
So I don't know what to tell you. I mean, from 2001 to 2011, commodities almost outperformed every year. I mean, that's what the super cycle kind of looks like. I think we're in another one right now. But you're right. Betting on just the commodity index itself is not kind of my pitch. My pitch is more, let's go into the second or third derivative of that, and let's look at what's correlated with commodities that didn't appreciate last year. And a lot of that has to do with these Latin American equity markets and currency markets. Also Russia, I think if I'm right, and if Putin's happy with what he got, and by the way, you know what he got? He got all of us to look hysterical.
Yes.
He
certainly did.
And literally that was the term the Russian foreign ministry used. You guys are hysterical, which is like, that's a win. That's like, check. Let's imagine a scenario where Russia says, okay, cool, that's it. We got these guys to dance around to our tune. It looks great in domestic TV. We look strong. They look weak. They look discombobulated. Let's just pull back here. If that happens, Russia's also another interesting buy. Now, I wouldn't be buying it right now. Let's just be very clear, Dan. I'm not telling anyone to go out there try to catch a falling knife.
Right.
Still a lot of things to get resolved. They can go into a limited incursion that still gives you 20% down. But I do think that commodity-linked plays are going to be an interesting alpha opportunity in kind of tactically next year. This year.
And just to be clear for the listener, I'm playing devil's advocate here because we're just about to put out a report that's got like 10 names in it that are, it's like this 10 stock inflation beating report that's got commodities all throughout. It's like commodities and infrastructure. And I always throw an insurance.
I want to read this report.
Yeah. All right. Well, as soon as we get it out, I'll forward you a copy. It's 10 stocks from my current portfolio that we've kind of set aside and said, if you're worried, these are the ones. But
Nice.
and there's an insurance company in there too. I always throw that in because they insure property and hard assets and things, and property and hard assets goes up, insurance premium goes up. Anyway, I just want to say you made an interesting comment. You said it didn't even matter that they didn't have copper exposure, like in the Chile ETF or whatever. And I immediately thought, and the money is going to wind up in the banks. If you know anything about how mining companies are run and what happens to them full cycle, right? The cash is there's going to be more cash in the bank at the end of that cycle than in the copper company, right? You know, Marco, you sound like an old soul to me, man. You really do. I mean, I know.
I'm from the third world.
Yeah.
You know, I grew up in war and hyperinflation, my friend. You know, so
Right.
this is, I've literally lived through a hyperinflation, which I don't think we're going to get to, just to be clear. I don't think you have to stack gold bars like, you know,
Sure.
in your apartment. But I do think that, you know, what people are missing is that they're anchored to what worked last decade. And trends tend to not, I mean, for whatever reason, trends tend not to work for a lot longer than a decade. I think this tech trend in the US was probably going to expire in 2020 with just a run-of-the-mill recession. We were going to rotate to something else.
Yeah.
I think the reason it didn't is that COVID juiced up tech stocks for 3 more times. There was the big COVID you know, surge in 2020 when we were just buying risk because there was stimulus. Then there was Delta in 2021, and then there was like the last Santa rally led by Omicron. But I think now we're at the end of that decade-long trend, and it's just, you know, it's not the end of the world. We're just going to be rotating violently. We could have done it nice and easy last year, but Delta prolonged that tailwind for tech stocks, and now here we are.
Okay, so one of the, I think of it as a macro bet anyway. One of the macro themes that, and there aren't a lot of them besides inflation, that mean a whole lot to me as a sort of bottom-up traditional value guy. But one of them that does mean something, of course, is the value growth trade, right? You can subtract the value stocks from the growth and you get an index of how that performs. And of course, we know value is cheaper relative to growth right now than since like .com peak, you know, it's just insane. Do you care about that one at all?
Of course.
Yeah.
Massively. Oh my goodness. Yes. Yes. You know, I have this great chart, Dan. It's COVID cases globally going up and down, and like daily cases. And it correlates perfectly with like MSCI IT over MSCI Energy, which is a proxy for value growth. Not perfect, but pretty good. And, you know, 1-to-1 correlation throughout 2021. It was all about that. And then Omicron, cases go through the roof, outperformance of growth versus value collapses.
Right.
It's the market speaking to you that, you know, growth outperformed value because of 2 reasons, really. One, this is a human virus, not a computer virus, obvious, but important.
Yes.
We all plowed into tech plays because of that. Yep. I mean, you know, I don't want to say any names of any stocks, but like when you were buying a bike company with an iPad on it, you know, like you're doing it like for this reason. We're all stuck at home, blah, blah, blah. That narrative worked really well. Yeah. The other one is that US is a country full of people who aren't really scared of COVID. And this is important because if you were sitting in like Taiwan or China or Europe, you were looking around and you were looking at what your policymakers were doing with lockdowns. You were like, I want to be where the committees are. Yeah. You know, I want to put money in a place where people are kind of like, man, blasé about this stuff. Right. And that's why so much equity moved into the growth heavy US market. Yeah. As COVID dissipates, that flow is going to drain the other way. So I do definitely care about growth value. It seems to have been perfectly correlated with the 10-year yield, with COVID growth cases, all this stuff. Yeah. And now we're going the other way. And America, you know, like America is still going to do well in terms of economic performance. Don't get me wrong. It's just that the advantage the US had, which was this kind of like, hey, live and let live attitude, which America adopted first, that gave the US that advantage last year. Now it's spreading everywhere else. You see Australia adopting that attitude too. Europeans are slowly as well. There's a few holdouts in the G20, but you know they're going to be swept by the side. Yeah, and interesting, possibly just coincidental that you know the attitude about COVID no longer being such a great advantage just happens to coincide with what looks like the beginning of the end of this massive bull market going back to 2009, let's say, you know, and the growth of value and all the rest of it. It's interesting how these things come together. Yeah, I think again, like I think the growth value would have happened with the 2020 recession. Anyway, you know? Right? Yeah. You know, like this was the just juicing up moment. Yeah. Now the question is, are we in a true bear market or can we rotate out of it?
Right.
So it's like rotation versus recession is my big question mark.
Right.
And I think, and this is ironic, maybe most people wouldn't agree with this, but I think as long as the 10-year is selling off, as long as the yield is rising, we're good, actually.
Yep.
I mean, if you
Sure.
own tech stocks, you're not, but it's good because it suggests that they can raise rates.
Yeah.
But if the 10-year suddenly catches a bid and they keep being hawkish, then we're going to invert the yield curve, and then we have a recession, and then you need to call cash or gold.
Mm-hmm.
Right. And then there's nothing else left. I mean, you're not going to be picking value stocks in front of a recession.
No.
And so that's why I think if you believe in value, if you believe in cyclicals or commodities or emerging markets, you need the 10-year to keep selling off. And that keeps being really bad for anyone still holding tech stocks.
What about, I know one thing on our listeners' mind, anytime we talk about rising interest rates, and we've directly addressed the 10-year, anytime we talk about rising interest rates, they point to the amount of debt the federal government has issued and said, there's no way you can do this because at some point, the interest payments overwhelm the budget, et cetera. You know the narrative, right?
Sure.
But
yeah.
But of course, I always say, well, who says they have to earn a penny, right? They can print as much as they.
That's a great point.
The government
That's a great point.
doesn't have to earn money to pay that debt with, right? I mean,
well, there's also other things that like the U.S. doesn't lend out the variable interest rate. It's not borrowing on a variable teaser rate. The U.S. government, there's like maturity issues and things like that allow the U.S. government to weather a move from 0.5 to like 2.5.
Mm-hmm.
But what the Fed wants, I think the Fed wants to crush the one asset it can crush, which is real estate assets. I think that's a real political problem. I think that's a real renting. Rent costs are still going to rise.
Yeah.
They're between 20 and 40% of CPI, depending which CPI you take core or whatever. So I think that it is in the interest of the government and the Fed to raise long end yields, which are associated with mortgage rates, high enough, allow them to increase high enough to kind of take some of the heat out of this real estate market.
Mm-hmm.
So that's something to watch for. I was the biggest bull in real estate. I told this to not just in my research. I mean, I write for institutional investors, so it's not like they really care about home prices. But I told all my buddies, hey, listen, go buy 5 condos, do whatever you can, just buy real estate.
Mm-hmm.
That was the trade for 2 years. It made a lot of sense. Now, I think the Fed is mad. There's enough people like me kind of did that. And I think that they want to curb that. I think that that's something that's in their interest. That's not going to hurt the U.S. government. It's going to hurt people who are leveraged to real estate market. And I think that it's not going to really become a problem for U.S. debt unless the 10-year, goes north of 5%, which I don't see happening anytime soon.
Yeah, so that will crush the Airbnb crowd because I'll tell you, those guys are minting money right now. I mean,
that's a great point.
We before we moved into our house, we were kind of in between and didn't have a place to go. And we thought, we'll just do an Airbnb. And we did, but we paid $7,000 for a kind of a little 3-bedroom, nothing house. I was like, holy shit, I'm in the wrong business once again, So,
yeah, with used cars, same thing.
Yeah.
But I think this is on their mind. This is on their mind, and they know when the U.S. government will be in trouble. And they're quite comfortable raising that 10-year higher.
Mm-hmm.
I think that's what they're engineering. That's why there is a focus on letting the QT happen kind of faster than it has in the past.
Yeah.
I think that's what they're doing. That they're trying to engineer a steeper yield curve, which again allows them to raise rates. You got to have the 10-year blow off for you to raise front end rate. Otherwise, you invert the yield curve and we have a recession. So they're letting it happen for that reason. And 2, I think they're trying to take some of the heat out of the real estate market.
Let me run another idea by you. We had a guest recently who said, if the stock market and in general asset prices, and we threw housing in that bucket too, he said, if the stock market falls far enough and, let's say housing falls far enough too, the Fed won't have to do anything or may have to do a lot less. So, and he said, they're in this jawboning phase now, right? Haven't actually done anything. And here we are down double digits on stocks. What do you think of that?
That's a great point.
Yeah.
I mean, I think it's fair. I don't think they have to do much. Look, again, it kind of depends where we are. If asset prices deflate, including S&P 500 and real estate prices, I think that solves some of their problems.
Mm-hmm.
I think inflation, CPI, provided that oil prices don't go to $200 because of some geopolitical event, but I think that inflation will peak at some point this year, just for second derivative reasons. And I think that's what they'll take that as a win at some point, not anytime soon. And that's why I don't want to tell your listeners like, hey, there's a Fed put, go out and buy. This is a buying opportunity. No, they're going to be stern. They're going to be mean.
Gotcha.
They're going to be old school until they're not.
Right. That makes sense. All right. Well, we've actually, time has flown here. So it's time for my final question, which you've answered a couple of times already. And so you may remember what it is. It's the same for every guest, no matter what the topic. And that is, if you could leave our listener today with a single thought, what would it be?
That's awesome. I think right now, I want to harken back to your Ukraine question, if that's okay. And all I would say about that is, let's just be aware that Russians have their propaganda, we have our own. And I think that's very important, because if you're an investor trying to make asset allocation decisions, just be sure you understand that our own media can often obfuscate issues or make them seem more alarmist. And I think that's a little bit of what's going on with the Russia situation. I think that's the way to approach it. So keep in mind, Russia has its RT. We have our own media organizations as well.
Very good. That's excellent. And the general idea, I would say, is equally good. Just turn that critical eye on yourself or on your own. It's a good idea. Thank you for that.
The guy I learned this business from. I mean, there's a lot of people I learned the business from, but one of them, Tony Beck. Great guy at BCA Research for a long time now at Alpine. He always used to say when something happened is, don't do anything, just go take a cold shower. And I think that applies definitely to this situation.
Excellent. If you're worried about the Ukraine, in the shower you go.
In the shower you go. Yeah.
All right. Well, thanks a lot, man. It's great to talk to you. You're actually you're one of my favorite people that we've interviewed in the last couple of years, because
that means a lot.
Yeah,
man.
well,
thank you.
Look, we've interviewed a lot of great people. Don't get me wrong. We have a lot of great guests.
For sure.
But, there's this sweet spot of talking about a complicated thing in a way that everybody can understand, and just me being able to fire anything at you and you being totally comfortable with it. And you're definitely in that sweet spot, and I'm sure the listeners appreciate it. So thanks.
That means a lot, Dan. I mean, you've done this longer than I have, so you actually know when you say that what it means. And to me, it's always like I genuinely want people who listen to me to walk away with it and either learn something or make money, or hopefully both.
Right. Yeah.
And hopefully not learn that I don't know how to make money.
Yeah, that's what we don't want them to learn. All right.
Hopefully that doesn't happen. Watch Putin tomorrow. Go you know what? I subscribe to Stansberry Research. I heard this guy Marko say I wasn't going to invade. Now I'm going to invade.
That's right. Yeah. Putin's listening to us. That's right. Okay.
That'd be awesome.
All right.
Thank you.
Yeah, thanks a lot, Marko. We'll talk to you again sooner rather than later, hopefully.
Hey, anytime.
Yeah.
Thank you, guys.
Right. Bye-bye.
Bye-bye.
I hope you enjoy the talks with Marko as much as I do, because I get a lot out of him. Like I said, he's in the sweet spot. He's a great talker. He puts things in language we all understand. They're complicated issues. And I hope you notice, every time we talk to him, his knowledge of history shines through all the time. He was talking about Finland, remember? I was like, oh yeah, geez, 1949. That's quite an example to pull out of your head. So he's really got an excellent perspective on macro issues. And like I said, a friend of mine who works for Stansberry Research lives in the Ukraine, has lived there for a decade or so. And they're not worried. So maybe we shouldn't be either. You should at least entertain the other side of the issue, the other possibility that maybe it's not as bad as the Western media makes it out to be. At least do that. All right. That was great, man. Now I'm fired up to do the mailbag. Let's do it right now. If you own gold or gold stocks, please listen to this warning immediately. The man who predicted the 2020 crash sees major warning signs. An event in 2022 could have a massive impact on gold and other sectors. The man is Mark Chaikin, and he says, move your money in the early days of 2022. That means right now, folks. The last time Mark issued a public warning like this, the market went on to see its biggest one-day drop in history. To get the full details, visit www.2022tradingsystem.com. Again, that website is www.2022tradingsystem, all one word, 2022tradingsystem.com. Check it out. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows and respond to as many as possible, or you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Okay. First up this week is a very thoughtful question from Steve, just Steve. Steve says, "Hi, Dan. I appreciate what you do. I'm an Alliance member and became one shortly after graduating college and flying in the Navy. I've learned/developed my own investing style and have you, Porter, Steve, and Doc to thank for my outstanding education. So here's my question or disconnect with the tech sector. Most market insights are lumping all of today's tech together. That's a mistake. Many of today's SaaS companies are in secular growth markets, data security, etc. These companies are critical to their clients' success. They have exceptional unit economics, margins, strong free cash flow, many with no or little debt. Not only are these companies critical to their clients' success, you could argue they could be the reason their clients succeed in the future." And then he gives some examples, Autodesk, Palantir, et cetera, et cetera. He's got a bunch of examples there. The current sell-off is treating these tech companies like dot-com day pre-rev pipe dreams. They are not. The reality is, even in a rising interest rate FED, a rising interest rate Fed, sorry, they'll improve margins, likely take market share and compound returns. That said, great companies can be disconnected from stock price, so valuations matter. And regardless of what we think, market sentiment moves markets. As a long-term investor, 20 plus years, how can we not see this sell-off as an opportunity? A correction is healthy, multiple compression is healthy, but these are companies that will grow and thrive. So how can we not see this as a buying opportunity? My best, Steve. Steve, I don't disagree with you at all. My only caveat would be this. In a bear market, if this is one, no one is spared, right? This is a point that I've made a few times since about 2017 or 18. In a bear market, great companies, gushing free cash flow with all these great attributes that you list here can fall 50% just like everything else. So you're right. That it is a buying opportunity for great businesses as long as you do plan to hold them for the long term. But don't be surprised if they get hammered along with everything else. Great question, though. This is definitely a critical thing for people to think about, and I'm glad you brought it up. Next is Sheldon S. Sheldon S. says, question, I understand that bank depositors are considered unsecured creditors in the event of a bank failure. Bank accounts are supposedly insured up to $250,000, but I understand that FDIC has only enough money to pay about 30 cents on the dollar if there are widespread problems. Are investments held in a brokerage account, street name, also treated as being owned by the brokerage? Does the expression, if you don't hold it, you don't own it, apply the same as for precious metals and crypto? Sheldon S. So Sheldon, the FDIC, I think they actually hold something equivalent to like 1% or 2%. I haven't looked at it lately, and I didn't look it up for this, but I know it's in the ballpark of 1 or 2% of all the deposits in the country. So it's worse than you said. But Um, you know, I I think the chances of you not getting your cash up to $250,000, which you went. I didn't read the other part of your email, but you were talking about getting losing 75% of your money in a worst case scenario. No, I think worst case scenario is you get all of it back, and it's just not worth that much anymore. It's cash, and cash becomes trash in a real crisis. But look, as far as regardless of what you think of fiat money, the way this system works, I don't think you're going to have a problem getting your bank deposits back. Now, you asked about brokerage accounts. That's not covered by the FDIC. That's covered by something called SIPC. I forget what securities. I forget what it's called. I forget what SIPC stands for. SIPC. But that's completely different. So maybe you want to. What I would say, what I always tell people is, don't ask me these questions. Ask your broker. Ask your equity broker, your online equity broker, and your crypto exchange. Shoot them an email, call them on their customer service line, do whatever you have to do to make sure you understand your relationship. You have a relationship with a counterparty who is holding your assets, right? You need to understand that relationship. That's the real point. That's the real reason I put this question in there, because it's not a question for me. It's a question for your broker, between you and your broker. It's about that relationship. So thank you for asking, Sheldon. Next is Alex W. And he says, hello, Dan. I enjoyed listening to Egon von Greyers from last week. He seems very knowledgeable. He made a statement that you allowed to pass without question, and I'd like to take issue with it. When discussing Bitcoin, he said, quote, they, central banks, will never let it replace the monetary system, end quote. I'd like to correct the statement to read, they'll never let it replace their monetary system. I'm going to stop there, Alex. Your email was longer and more specific, and I get it, but that's the point. It'll never replace their monetary system. And then you did go on to say, it would have stopped you in your tracks if Egon had said the U.S. central bank will never let Bitcoin or gold replace the monetary system. I don't know if it would or not. And you finished up by saying they may not let it replace the U.S. dollar, but that didn't stop the dollar from replacing the pound. All the best, Alex W. So, Alex, I get it. Like it or not, the U.S. dollar is, I think it's around 78 or 79% was the last number I saw within the last few months of global transactions. And I think still either in the high 50s or 60% of global foreign exchange. It's a dollar world, like it or not. But you are technically correct, and I cannot disagree with you at all. I don't disagree. I don't want to disagree. Gold is money. Yeah, it's taxed. You're going to pay a 28% tax when you sell it in the U.S. Gold is money. Bitcoin may or may not be, come into widespread use as a payment, as a currency. It's not a currency now. It's sort of like an intermediate payment system. It's kind of redundant most of the time. Most of the time, you're just converting dollars to Bitcoin and then Bitcoin back to dollars. But it proves that it kind of works, right? It definitely works. I've transacted in Bitcoin. But your point is well taken, and I don't disagree. That's really what I wanted to say to you. But I also wanted to point out that it's a freaking dollar world, man. Don't fool yourself. But you sound like a smart, thoughtful guy, so maybe you're not fooling yourself. Next is Paul B. He says, hi, Dan. I love the show, your newsletter, and your other Stansberry contributions. Well, thank you, Paul. Paul continues, I gravitated toward the show way back when Porter and Buck Sexton ran it and thoroughly enjoy what you've brought to it. He says, I've heard you talk about portfolio protection with long-term option puts. I recently read in Doc's advanced options newsletter that one could use long-dated bear spreads to protect from a market crash. Could you give some examples of either or both and compare the two strategies? Thanks, Paul B. Not really, Paul. I don't do those spreads. I don't know them. I've never used them. Doc is much smarter than me. I mean, this guy, he kind of created, I forget exactly what he did at Goldman Sachs, but I think he like created their options, some options program that they still have. So, like he's smarter than I'll ever be and knows more about all this than I care to. All I do is look out, usually 9 to 12 months, and go out of the money 20, 30, 40, 50, 60, 70% and just put a small amount of money. And I don't even really care about the pricing, whatever it is. I just look at the market. And if the market is, surging upward amidst what I think is the biggest bubble in history, I do what I just said. I go out, that far in time and that far down in price. And I spend an amount of money that I don't care if I lose all of it or not. And it's either going to go to zero or pay off at some point. And lately, the past few days this week, I was in the green finally, after being in the red and closing, having a lot of positions expire worthless. But, it's a few $1,000s. It's meaningless. This is not what I did that for, in other words. We're not anywhere near. Like, I'm not, the only thing I did, there was one position that it expires in June. And we're here in the end of January. And it's actually slightly underwater, but it's way up from where it was just because, the market had all these down days. And I'm thinking about blowing that one out. And then, then my nearest position will expire in September. But who knows? I might leave it alone. I don't know. I think, if Greg Diamond is right, and we had him on the program fairly recently within the past couple weeks here. If Greg Diamond is right, the top is in and it could get really ugly starting March, April. So maybe I'll just leave that June put right where it is. That's about all I can tell you, Paul. It's not very sophisticated, right? It's just like, I'm throwing some money at a cheap insurance policy is the only way I think of it. Lodevik H., our very thoughtful and frequent correspondent and faithful listener, has written in this week once again, and he says, a question. Why buy now? We have a bubble everywhere, so why invest? Why not go out of the market, exit, go into safe havens like gold, silver? Some people also say Bitcoin. I think I would prefer real estate, but that is just a cash flow opportunity. I'm thinking about investing in real estate in the coming 3 months. I'll listen to books and podcasts, then make a decision if. He says, then I like to counter that it is a highly illiquid asset. Good counter, Lodvig. I think you're right to acknowledge the highly illiquid nature of real estate. When everything's falling apart, you can't sell real estate any easier than you can sell anything else, less easy even. And he continues, he says, I like the CBOT guest. I think you might be talking about Mark McGlone. You might be talking about back in December, Bubba Horowitz. But why move? Oh, Bubba Horowitz did not work for Bloomberg. Mike McGlone is who you're talking about, because then you said, why move to Bloomberg? And you can specify with 21 reasons or motivations. I don't know the 21 reasons or motivations why he went to Bloomberg and is not trading anymore. I do know, though, Lodevik, that, if you ask this kind of question to like Steve Sugarroot or somebody, why aren't you still, back in your hedge fund days, like in your early part of your career? And the lifestyle is just really, it's awful for some people. You're waking up at 3 a.m. looking at price quotes and all kinds of stuff. And this lifestyle is much, much better. And you're doing almost the same, a lot of the same kind of work. So I don't know what Mike's reasons were, but it wouldn't surprise me if it was something like that. And finally, Lodevik says, maybe a stupid question, but how is the Bloomberg terminal different than the radio network, the magazine, and TV? It's way different. It's this massive tool that is just, it is so deep and so filled with information. You can do equity screening and trading, options research on any asset class in the world. It is incredible, and it's incredibly expensive. Stansberry has a Bloomberg account for me that I use every single day, and I think this thing is like, it's like $2,500 a month. I want to say something like that. It's really expensive, but it's worth it if you're in certain businesses like ours that we depend on our ability to research things, as deeply and quickly as possible. And deep and quick are not exactly compatible all the time, and a tool like Bloomberg is essential to get that kind of work done. I hope that explains it to you, Ludovic, and thanks for the questions. I'm sure we'll be hearing from you again very soon. All right, last up this week is Derek F., Alliance member Derek F. And Derek says, "Hi, Dan. I've been enjoying listening to the Stansberry Investor Hour since the early Porter days of the show. And of course, everyone you've hosted. Towards the end of show number 242, you were talking about Russia and said, the current regime is a bunch of crooks, oligarchs. Putin went to the oligarchs and said, I'll leave you alone, but I need 50% for me," meaning 50% of the oligarchs' companies. "I'm in the middle class. The regime I live under approximately taxes my income at 28% nationally, 7% state, Social Security 12.4%, sales tax 8%, and now well over a 10% inflation tax. The oligarchs in my country, in tech, pharma, finance, defense, and the government, write the laws for themselves and their business interests so they can afford to be excluded or deal with taxes. But us in the middle are never left alone and must bear the brunt of our regime's leviathan of taxes, both directly and indirectly, while it pulverizes us out of existence. Doesn't it seem like the Russian oligarchs have a better deal than the middle class in the USA?" Alliance member Derek F. Derek, I hear you loud and clear. And your point is well taken, because in the Russian oligarch situation, you're right. It's a one-time thing. You take 50%, then you're done and you leave me alone, whereas we're never left alone by our government, are we? Everywhere you turn, there's another tax. And look, we get stuff from taxes, right? We get roads, we get whatever else we get. I don't want to go into the whole list, but I think anyone who believes that there isn't a better way to do it than tax is not in the conversation. You're so off base that if you think that taxing people this way and basically violently seizing their income and assets this way is the only way to pay for these, perhaps essential services, which there's really no such thing. Essential is whatever is essential to you. Then you're not in the conversation. You're not in the conversation if you think this is not way too much and that government hasn't gone way too far. Government has gone way too far. We do pay way too much taxes. Most of the money is really kind of flushed down the toilet. And this idea that government was this sort of utility that operated, courts, and basically was there to prevent infringements against our person and property is long gone. Now it's been seized by ideologues as this instrument for do-gooding, and that's always bad. So I agree with you, Derek. I really do. And I'm glad that you asked the question. I know this isn't a political show, okay, but you were responding to something I said, and you were right. I think your interpretation was spot on, Derek. So good on you. Thanks for the question. And that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might enjoy listening to the show, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, would you? Subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop us a note at feedback@investorhour.com. Or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.